An ETF, which stands for Exchange Traded Fund, an index fund, and a mutual fund, are all investment funds that let you buy a diversified set of stocks or bonds, but they differ in how they are bought, sold, and managed. A mutual fund is a broad category that includes actively managed funds, where a professional manager picks stocks to try to beat the market, and index funds, which passively follow a market index like the Standard & Poor's 500. Mutual funds and index funds can only be bought or sold at the end of the trading day at a price called the net asset value, while exchange-traded funds trade on the stock exchange all day, like regular stocks, meaning their price fluctuates based on supply and demand. In terms of fees and costs, actively managed mutual funds have the highest expense ratios, usually 0.5% to 2% per year, because you are paying for professional management, while index funds and exchange-traded funds have much lower fees, often 0.03% to 0.2% per year, because they simply track an index. Minimum investment requirements also vary. Mutual funds and index funds often require a minimum investment, for example, $500, $1,000, or more, while exchange-traded funds have no minimum investment because you can just buy a single share, or you can buy a piece of an exchange-traded fund with just $1. Tax efficiency is another key difference. Exchange-traded funds are the most tax efficient because of how they are structured, meaning investors rarely have to pay capital gains taxes unless they sell their shares, whereas mutual funds and index funds can distribute capital gains to investors, making them less tax efficient. If you want active management, a mutual fund may be for you, but if you prefer low-cost passive investing, an exchange-traded fund or index fund is better.